Imagine a company that manages more money than the economies of Japan and Germany combined. An entity with so much financial power that its decisions impact markets worldwide. This company is not a bank, nor a country, it's BlackRock. With almost $11.6 trillion in assets under management, BlackRock is the largest asset manager on the planet. But what exactly does that mean? How does it make money and, more importantly for us, investors? Is it a good addition to a long-term portfolio? BlackRock's business model is diverse. About 53% of its assets are in stocks, 26% in fixed income, and the rest in multi-asset, money market, and alternative funds. But its big difference is that 2/3 of its long-term investments are in passive strategies. Think of its famous ETF platform, iShares, which is a global market leader. In this video, we're going to analyze BlackRock, divided into 6 key sections for you to understand the company and make your own decision. We'll look at its strategy, financial strength, its incredible competitive advantage, the risks, how it allocates its capital, and finally, our conclusion. Let's get started. Business strategy and outlook. The traditional asset sector has faced big challenges. With pressure for lower fees and the rise of passive investing, many traditional managers are struggling. But BlackRock has turned this challenge into its greatest strength. While others struggled against the tide, BlackRock, being essentially a passive investment giant, rode that wave. With iShares, it positioned itself exactly where investors, both retail and institutional, were going: low-cost, transparent, and efficient products. But what about the future? The strategy doesn't stop there. For the next 5 years, BlackRock is focused on 4 growth pillars. 1. ETF market expansion. They are already leaders, but the market continues to grow, and they aim to capture even more. 2. Improvement in active funds. They haven't given up on active management and seek to improve performance to compete. 3. Focus on alternatives and multi-assets. They are expanding, often through acquisitions, into higher profitability areas. 4. Technology. Their Aladdin platform, which is a risk management system, is a technological differentiator that they even sell to external clients, generating technology revenue. The outlook, therefore, is for a company that is not resting on its laurels, but rather using its scale to continue growing and adapting. Financial strength. A company of this size needs to be financially strong, and BlackRock takes that seriously. Historically, the company has been very careful with its debt. Its debt-to-capital ratio averages a low 16%. They have billions in debt, of course, but with very well-staggered maturities over the next few decades. And for any emergency, they have a revolving credit line of over $5 billion that wasn't even being used at the end of 2024. That's financial discipline. And what do they do with the cash they generate? They return it to shareholders. Between 2015 and 2024, BlackRock spent almost $17 billion on share buybacks and paid almost $23 billion in dividends. They just increased the quarterly dividend at the beginning of 2025, and the expectation is that it will continue to grow, maintaining a healthy payout between 35% and 45% of profit. It's a machine for generating shareholder value. Competitive advantage, economic moat. Now the most important part for the long-term investor, the economic moat. What prevents competition from stealing BlackRock's market? The answer is a gigantic moat, based on 3 main factors. First, switching costs. It may not seem like it, but it's very difficult for a client, especially an institutional one, to change managers. There's inertia, the uncertainty of getting a better result, and even tax consequences. The money that comes into BlackRock tends to stay. This is proven by the company's positive organic growth rate year after year. Second, intangible assets. The BlackRock brand is synonymous with trust in the institutional world, and the iShares brand is, for many, synonymous with ETF. Building that reputation takes decades and billions of dollars. It's an immense barrier to entry. And the third, and perhaps most important, cost advantage by scale. Because it's the largest, BlackRock can achieve operational efficiency that its competitors can only dream of. This allows it to offer passive products like iShares ETFs at extremely low fees, putting pressure on all competition. It's very difficult to compete on price with the industry giant. Put all that together, the scale, the brand, the product diversification, and the global presence, and you have a company with one of the widest and deepest economic moats in the entire financial market. Risk and uncertainty. For BlackRock, the main risk is its very nature. More than 80% of its revenue comes from fees charged on the assets it manages. What does that mean? It's simple. If global markets fall, the value of BlackRock's assets under management falls. And if the value of assets falls, fee revenue also falls. It is directly exposed to the performance of the economy and stock and credit markets. Another risk is the continuous shift of investors to even lower-cost products. If the migration from active to passive funds accelerates, this could pressure profit margins. The company is also under constant scrutiny regarding ESG, environmental, social, and governance issues, but analysis indicates that it has managed this issue well, minimizing direct financial risk. Investors need to be aware. By buying BlackRock shares, you are making an indirect bet on the health and continued growth of global financial markets. Capital allocation. How a company uses its money says a lot about its management, and BlackRock's management, led by the legendary Larry Fink, receives top marks in this regard: exemplary. Their capital allocation philosophy is based on 3 areas. 1. Maintain a solid balance sheet. As we've seen, little debt and much financial flexibility. They are prepared for any scenario. 2. Efficient investments. BlackRock has a fantastic track record of successful acquisitions. They don't buy just to buy. They buy to fill gaps and expand their capabilities, as they did to strengthen the alternatives and technology areas. The secret, according to analysts, is the company's strong culture, which can efficiently integrate new businesses. 3. Shareholder distribution. They are incredibly shareholder-friendly. As we've already mentioned, the projection is that they will continue to return most of their free cash flow via growing dividends and share buybacks. They are committed to repurchasing $375 million in shares per quarter, and can increase that amount if they believe the stock is cheap. This is the mark of top-quality management: disciplined, strategic, and rewarding those who invest in the company. Conclusion. So, let's tie all this together. BlackRock is a giant. It's the undisputed leader in a sector that benefits from a long-term secular trend: the growth of passive investments and ETFs. It has a wide economic moat based on its massive scale, strong brands, and customer switching costs. Its financial strength is robust, and its capital allocation is exemplary, focused on strategic growth and returning value to shareholders. On the risk side, its revenue is directly linked to the ups and downs of financial markets, and pressure on fees is a constant challenge. The question for investors is, do you believe that, in the long run, global financial markets and consequently companies and the economy will continue to prosper? If the answer is yes, BlackRock is not just a player in this game, it owns the board. It presents itself as one of the most robust and well-managed ways to get exposure to the growth of the global capital market. A true blue chip of the financial sector. That was our analysis of BlackRock. Remember, this video is not a recommendation to buy or sell. The goal is to give you the best information so you can make your own investment decisions. What do you think of BlackRock? Do you invest, or would you invest in the company? Leave your comment below. If you like this analysis and want to see more videos like this, don't forget to like, subscribe to the channel, and turn on notifications. This helps us a lot to continue producing quality content for you. Thanks for watching, and see you next time.